Hey everyone, Scott Smith with the Smith team at Keller Williams. Happy Friday. Wanted to share with you a quick update. Actually, I shouldn't say quick because I've got about 20 some slides. I wanted to share with you some of what's happening across the country, and obviously with what's happening abroad might have an impact with our local real estate market, but we'll see what, hopefully that everything turns out safe and sound with what's happening abroad. And we'll share with you what is cooking right now, looking at the February market stats from across the country. So this is from our great resource, Keeping Current Matters, that we subscribe to. They've got just great information, as you can see. One thing that we've been hearing a lot about is inflation. And obviously, we've it's made some headlines in the news, and we've seen prices go up significantly across the board, many different areas of the economy, real estate certainly being one of them. But one thing that people always talk about is that how real estate is a hedge against inflation. So share with you this next slide. It's one of the most time-honored inflation hedges. Tangible asset, those tend to hold their value when inflation reigns. Unlike paper assets, more specifically, as prices rise, so do property values. So we've definitely seen that historically. Certainly holds true. This is just what inflation rates have done, and then home price appreciation. So obviously we saw pre-pandemic, and then obviously we saw prices drop significantly. Many commodities like gas, oil, because people were just doing stuff at home. They didn't need all those. So it's all supply and demand 101. And we've seen some pretty significant numbers with the price appreciation with that. Recent years, this talks about inflation and how it kind of manages or compares actually with rental appreciation. So rent price increases fluctuates quite a bit year over year as the inflation rate will change. Homeowners are shielded from mounting rental expenses because their costs are fixed. So locking into a fixed rate mortgage, if you haven't refinanced and your rate is north of 5, certainly give us a call. We can help you out, get you connected with a really good loan officer. But locking in that interest rate is an awesome opportunity. I've talked about it many times, how you can actually save tens of thousands of dollars in interest over the life of that loan just by going from, let's say, something at 4.5, even a 30-year loan down to a 15-year loan is a significant cost savings, and might as well keep some of that money in your pocket versus giving it to someone else. Cumulative housing appreciation by 2026. This is an interesting slide because they're talking about where our price is heading. We've heard the B word in real estate, talking about a real estate bubble, but everything that we've been hearing is we're going to see more stabilization and consistency as it's going to take years for new construction to catch up with the demand and with the supply of homes for sale. So optimists obviously are seeing things a little bit more rose-colored glasses. Pessimists, but even if you look at the pessimist, over the next 4 years, they're still planning on at least 5 to 6% appreciation over that time frame. So we've got quite a swing in that. But if you look at just what they're planning on, we're going to see some significant price increases. So real estate is a good asset to hold on to. Mortgage rates, that is what has driven a lot of the demand. Obviously, mortgage rates have been low and they've been kind of creeping up. Mortgage rates remain unchanged from last week. Actually, this slide's a little bit older. We've actually seen mortgage rates ticking up over the last week, but with what is happening in Ukraine and Russia, we're probably going to see the economy slow down a little bit, and we're going to see interest rates drop back down into the mid 3s from the upper 3s. So we'll see how that happens. This is actually from the beginning of February. So what a difference a month can make. And locking in, look at a 15-year loan at 2 3/4, a 5/1 arm at 2.71. That's just some fantastic rates. And here's a little bit of a historical perspective, going back to 2020 and looking at kind of what they've done, where they dropped, and then kind of started moving back north. Historically speaking, back to 2018, kind of where we are, the 3s, the 4s, and the 5s, we're heading back up, but we're certainly in awesome price range with that. So if you're looking at comparing to the last 5 decades, we're mortgage money basically hasn't been any cheaper. But putting it into perspective, if you talk about anyone that bought a house back in the 80s or even the 90s, interest rates were right around that double-digit mark. So I always kind of joke that it's like buying a house on a credit card. The prices back then were also quite a bit less, the same as you might find for a car. So if you like to track what is going on with interest rates, if you just look online and you track that 10-year Treasury yield, obviously you can see a pretty close correlation to what is happening with that. So on a daily basis, it's something I look at just to kind of see which direction mortgage rates are heading. And that 10-year yield is absolutely a good resource that everyone can kind of watch to see what's happening with interest rates compared to a 30-year fixed. Forbearance. If we're going to see a bubble with all these foreclosure properties or shadow inventory coming on the market, probably not. So the COVID pandemic created some uncertainty with that, where people were out of jobs. But the difference between now and where we were a decade ago is that we actually have equity in our homes right now. Those lower interest rates, people have got plenty of equity. So slide this down. So you can kind of see where we are. Anyone that was in some type of forbearance program, if they were not able to have get out of their home or sell it, or do some kind of loan modification or deferral, this is kind of how that pie is sliced, where people are. But very, very few people have come out of that without having a good solution where they can remain in their home. Historical perspective. Where we are now with short sales or foreclosures, it's just a blip on the radar. It's very, very rare that we're even seeing that, again, because people have that equity in their home. Percentage of distressed property sales, another way to look at it. Way back in 2012, 2013, you can see almost a third of all transactions, it's still hard for me to believe back then, were some sort of a distressed sale, short sale, foreclosure, property. And now we are basically, like I said, a blip on the radar. And historically speaking, usually you'll see, even going back to pre-2012, in a normal market that wasn't artificially created by the mortgage crisis, you'll see anywhere from 4 to 5% of transactions. So 1 out of 20, you might see something like that, depending on the market. But again, it's just a very, very small blip in the radar. Might see a little bit of an uptick with that since they've lifted the foreclosure moratoriums in different states. And so we might see a little bit, but realistically, we're able to kind of work people through that. Any resources that you need from us, our spring buyer and seller guides are going to be coming out next week. So certainly reach out to us if you've just got great information that we're happy to share with you. We can either email it to you, or you can we can get you a printed copy of it too. Housing inventory. What's going on with housing inventory? Obviously, it's low. Everything's flying off the shelves, but the transactions are actually up. So this is pretty typical for our Minneapolis, St. Paul, even though this is a national stat. But we usually will see our inventory peak in the summer months and then settle down in the kind of the bookends of everything. So the fall and Thanksgiving the market takes a nap between Thanksgiving and the Super Bowl. Buyer demand, obviously interest rates, but this is an interesting chart where it kind of shows where we're more in a stable buyer's market. Now, again, this is coming out of December, when in the Twin Cities, everything is slow and cold, and the market really hasn't kicked in yet. That is not the case now. If you look back a couple months from now on what this slide's going to be, and it's definitely going to be a strong in demand. We're hearing from our realtor friends that are across the country that, especially in the South, that their spring market is stronger this year than it was in 2021. What is happening with mortgage rates? This is a great chart again, what we're expecting to see. You can see at the bottom where we saw back to 2016, kind of what was happening with interest rates. And we're still below where they peaked back in 2018, 2019, and projecting that it's going to be up into that right around 4% again, depending on what is happening across the world. This is a stat or a chart that I like to share with people, just because people always wonder kind of where they lie with their 800 credit scores or with their credit scores. But basically, 14% of the people have that 800 credit score, nearly perfect credit. But really, the vast majority of people are underneath that, 750. It's a pretty good distribution with that. And mortgage companies have actually loosened some of their guidelines because people are putting more money down on a home, so the risk is actually less. So I wanted to share with you, and I probably talked pretty quick to try and get through everything. But again, reach out to us if you want copies of all these slides or some other ones that we'll have included in there. What is going on with the spring market and getting in a position to buy a home or sell a home in today's market is certainly quite an adventure. We're happy to help you navigate through that. Reach out to us. You can call us at the office, 651-777-3434. Or just email me directly and we'll get you a copy of this. Wish you a happy Friday. Take care. Enjoy the weekend. Bye now.